Right. This class is a continuation from where we left over on Tuesday when we were looking at statement of cash flows. If we still remember, statement of cash flows, they record the cash that we've received and the cash that we have paid. Right. It is made up of three categories. We have got the operating activities, which records the cash flow from operations. We have got the investing activities, which records the purchase and sale of non-current assets. Purchase and sale of non-current assets. Then we've got the financing activities. The financing activities now look at cash paid and cash received by the, sorry, cash paid and cash received from capital and long-term finance. From capital and long-term finance. So those are the three categories. So in our previous class, we looked at the operating activities. We managed to find the cash flow from operating activities. So we found this cash flow from operating activities. Right. Now the next thing is to find our investing activities. Now remember that investing activities is the purchase and sale of non-current assets, as I stated in the previous class. If you still remember, investing activities amount spent on purchases of non-current assets and receipts from sale of non-current assets. Right. Normally we divide our investing activities into two categories. All right. Our investing activities we have got investment to expand operating capacity. Right. This represents investments for growth, whereby maybe you are expanding your operations and you need to buy more machinery. You need to buy a new building in a new location where you'll be opening a new shop. That will be expanding. Right. Then we've got investments to maintain operating capacity. This is investments to replace sold or scrapped assets. Let's say you've got a vehicle, it had an accident, then you buy a new vehicle to replace the old one. So that will be investment to maintain operating capacity. So when we say you are maintaining operating capacity, we are saying you are simply making sure that you operate at the desired level. Right. So you are just replacing assets that are worn out. So now, then we'll have of course, the sale of assets. So we have to check if there is investment to expand, and we have to check if there is a investment to maintain operating capacity. All right, now let's read our information from the question that we are using. All right. On number 3.3, during the current year financial year, there were improvements. When you are talking about improvements, that's growth. Erected to the buildings, all costs were paid for in cash and capitalized. Land and buildings were revalued on 30 December 2011 by Mr. Mbujo and represents an independent sworn appraiser. Right, so that means they improved the building. So the moment that they improved the buildings, then we know that that's investment to expand capacity. So we can say investment in property, plant and equipment, fund. operating capacity. For investment to expand the operating capacity. Right. Additions to buildings. Right, if you check, we are not given an amount. So what we have to do, we have to go to the buildings, but we should be also be very careful because there was a revaluation. Now, a revaluation does not involve cash. So we should make sure that the increase that we take, it should exclude the increase due to revaluation, because a revaluation does not involve cash. Right, now we're told here that our land and buildings moved from 1,147,500 to 567,905. Right. So that's an increase there. Right. That increase, we should take out the one due to revaluation, which is the 40,000. If you can see our revaluation was 0 here, then it became 40. That means the revaluation was 40. So you should be very careful also with the revaluation, because if there was 10, for example, here, it could have meant that the revaluation for this year is only 30. But because it moved from 0 to 40, then there was a revaluation of 40. So we know that for of this increase from 567 to 1147, part of the increase was due to revaluation. So to get the one that that was paid for cash, remember in our cash flow, we just need what was paid for cash. We would take the buildings for this year, 1,147,500 minus the one for last year, 567,905. Then we take out the revaluation, 40,000. Yes. Okay. I'm waiting for you, my friend. Let's be fast.
539,595.
So it's negative 539,595. It's a negative because we'll be paying. Remember, any cash flow is a negative if we're paying, and it's a positive if we are buying. We are selling. Right now, let's check if there are any other investments to expand capacity. Then on 31 May 21, on 31 May 2021, machinery was sold at carrying amount. They sold machinery. Let's see again. I think that's the only thing. So the machinery was sold at carrying amount. All right. To get our carrying amount of assets sold, all right, proceeds from sale of assets. To calculate that, we say carrying amount plus profit, or minus loss on sale. Right. Then to get your carrying amount, if you are not given, like in this case, you can say of assets sold say carrying amount, it's end of year, at the beginning of year, sorry. Less carrying amount at end of year. Add additions during the year. Less depreciation during the year. Right, now if we can get this carrying amount here, right, our machinery, it moved from 600, 030, that is the carrying amount at the beginning of the year, to 482, 145. And there was depreciation of 91035. Our assumption in this particular case will be that we don't have a depreciation on the buildings. So all the depreciation that we have here was on machinery. So we don't have any additions on the machinery. So we'd simply say to get, remember it was sold at carrying amount. So we can say proceeds from sale of machinery. We'll get that carrying amount. They said that they were sold at carrying amount. So we'll take our carrying amount at the beginning of the year, which was 600,030. Then minus our carrying amount at the beginning of the year, which is 482,145, minus our depreciation, which is 91035. Right, if there was a profit, then we're going to add, if there was a profit on sale. If there was a loss, then we're going to subtract. What do you get? What do you get?
26,850.
6,850.
26,850.
Okay, that's a positive because money is coming in. Because money is actually coming into the organization. Right. Now, then we check if there are any other movements in the assets. Right, our general assumption is that there are two reasons why assets can go up, is because of additions and revaluations. And there are also reasons why they go down, that is disposals, depreciation. Right. So now there are no other assets, but we can also check this fixed deposit. Right, unless told otherwise, we always assume that a fixed deposit is long term, but they can tell you in another assessment that maybe the fixed deposit is a short-term investment. What we should know is that if it's a short-term investment, it will go under operating activities. If it's a short-term investment, it will go under operating activities. But the fact that we are not told, normally our fixed deposit, we should assume that it's a long-term deposit which falls under financing activities. Right, if we don't have any other information on the additional information to the contract, our assumption is that when the fixed deposit goes up, it means that we paid more money into the fixed deposit. Right, and when the fixed deposit goes down, it means that we withdrew our fixed deposit. So now in this particular case, we know that our fixed deposit moved from 50,000 to 100,000. So it increased. Barring any other explanations, it can only be explained by the fact that they might have invested money in the fixed deposit. But you should be very careful. You should also read the additional information because there might be interest. Right. So we don't have that interest. So we would say further investment in fixed deposits. Right. That is 100,000 minus 62,000. We get 38,000. When you put money in a fixed deposit, it means that you are paying money into that account. So it will be a negative. Right. So these are our normally this one here we have to show the total of the investment in expanding, because the company would need to know how much did we spend in expanding and how much did we spend in replacement. Right. Then we get our net cash outflow from investing activities. Right. We add up this one plus this one plus this one. So it's a net cash outflow because it's negative. Any questions on the investing? So the investing activities does not change whether you are using the direct method or indirect method. It still remains the same. Right. Then we go to the next heading, which is the financing activities. Right. Remember that financing activities, it's amounts received from capital and long-term loans. Amounts received from capital and long-term loans. Right. So we have to go on our equity and long-term liabilities. That's where we play around. Right. Our let's see our capital. If you can check here, our capital, it increased from 1,131,000 to 1,249,500. Right. So that increase, we assume that, unless told otherwise, that the owners, they put in more capital, so money will be coming in. If they go down, if the capital goes down, it means money is going out. But you should also be very careful, because on additional information, they can tell you that, for example, that the owner contributed furniture. So if he contributed furniture, we have to take out that portion that was contributed by furniture. Remember, we're doing a cash flow. We're only interested in the cash movement. Right. So that one would be that means the raised capital. Proceeds from capital contribution. Which is equal to 1,249,500 minus 113,165. What do we get?
Lev 117865.
117865. This one is money coming in. This is money coming in because they raised capital. Right. Then we check loans, long-term loans, not just short-term loans. They might be considered to be part of the operating activities. Right. Our loan, if you can see here, it also includes the current portion. Right. If our loan includes the current portion, then we have to combine them together. Now, if you can see, our loan, it was 201, but then it increased to 249,750 plus 27,750. We combine them because remember that although its current portion is just installments to be paid within a year, but they still remain part and parcel of the long-term loan. Right. Then you check if there wasn't any interest capitalized. Right here, there's nothing here. So we can assume that that was proceeds from loan. So we can say proceeds from long-term loan. That would be the difference between the two figures. So that's a 249,750 plus the current portion 27,750 minus the one for last year 201,000. So if we also had the current portion last year, we could also subtract that current portion. Right, what do we get?
76,500.
So it's money coming in. If the loan was going down, it could have meant that we have repaid. So we're going to include it as a negative. Right. Then right. Then we also had the loan from partner, which moved from 150 to 168. But if you remember from Tuesday, we told that interest was capitalized on this loan. There was interest capitalized on this loan, which moved it to from 150 to 168. There was 18,000 interest capitalized. If we still remember that 18,000, we calculated it somewhere. That 150,000 minus times 12%, it was the 18,000, right? So that interest was capitalized, so we don't have to record anything because the increase was due to capitalization. That means the loan did not change, it remained the same. And when interest is capitalized, it is not paid, it is just added to the loan, so there's no cash flow movement. So there will be no cash flow movement, right? So that's it on the financing activity. So on the financing activities, you'll be dealing with your capital and long-term loans, right? So would you have?
Oh, sorry, can I ask?
Yes, my boss.
Yes, I see the proceeds from long-term loans. You got 249.
Yes.
249,750. Where is?
I think you missed that when I was on the statement. Yeah.
Oh, okay. Oh, okay. Sorry.
This is the long-term loan and its current portion minus the one for last year. So if we also had a figure here, we're also going to subtract it.
Oh, okay. So why is it an inflow? Because isn't we giving out money?
When you take a loan, if you go to Mashonisa, my boss, and you get a loan, is that your pocket will be full?
Oh, okay. Oh, okay. Isn't
When you get a loan, you receive money.
Okay.
But when you pay now, when the loan goes down, that's when you are paying money is going out. So whenever a loan goes up, it means you are getting money.
Oh, okay, okay. Okay.
Okay,
Yes,
my
I'm
boss.
confused, because in normal accounting, when you borrow money, it's not actually your money.
No, you have a debt, but cash you have it. Remember, this is a cash flow statement. Of course,
Oh,
your
okay.
debts go up, but in cash wise, today, if you go and take 10,000 loan, you know that I've got 10,000 cash, isn't it? Although you are owing, but for today, for now, you have got a lot of cash. Is that right?
Yes, yes, all right, sure.
Yes. So for the
okay.
cash flow, don't think about the debt. We're not thinking about the debt. We're thinking about the activity that happened. Did it increase the cash of the entity? By taking the loan, the cash in the entity increased.
Oh, okay, okay.
Sharp.
Thank you.
So we're not talking about the issue about liabilities. That one is for the financial statements then. Here on the cash flow, we're just interested in the cash movement. Right, then we have net cash inflow from financing. Right, we add these two. Right. Then we get our overall cash flow. We have done all our three headings. Then we have to find out our net increase or decrease in cash. So you add up the three, the operating activities plus the financing activity, investing plus the financing. Right. Then you check if it's positive or negative. This is negative. So because it's negative, we'll call it net decrease in cash and cash equivalents. But if it was a positive, we're going to call it a net increase. Right. Then you add your cash and cash equivalents at the beginning of year. Right, you go and check what was your cash and cash equivalents at the beginning of the year. We know that our cash at the beginning of the year, which is the bank year, it was 405,000. The beginning of the year, we'll be talking about last year. Right, so that means 405,000. Then you get your cash and cash equivalents at end of year. So that will be the net decrease plus the cash and cash equivalents at the beginning of the year. So we'll say this plus that. We get 182,761. And the answer that we get should be equal to the cash and cash equivalents for this year. If you can check that this is 182,761, then you know everything is actually tallied. All right, so this is how we prepare a statement of cash flows. Any questions there?
Eugene,
Yes.
at the financing activities, you looked at the long-term loans, then at the long-term from partner, but not, no, yes, at the long-term to partner, but not at the long-term for partner.
It is, but there was no cash from them. It changed from 150 to 168. Is that right? How much is the increase? That's 18,000. If you check here,
Yes.
On number 3.5, we're told that the loan from partner was acquired on 31 December 2010. Interest is charged at 12% per annum and is what? Capitalized. When they say interest is capitalized, that means interest is added to the loan. Right. Then if you say 12% multiplied by 150, what do you get?
$18.
18. So that means the whole increase from 150 to 168 was because of interest capitalized. Interest capitalized means there was no cash flow. They just topped up the interest that we didn't pay. So there was no cash flow on that loan. But if this one, for example, if it was more than 168, then we could have calculated how much was obtained from there. Does that answer you?
Okay.
Hello? We are saying there was no cash from the loan. The loan increased from 150 to 168 because of interest that was capitalized. When we say interest is capitalized, it simply means you didn't pay the loan, so they topped up the loan with the interest. You didn't get any cash. So that increase was because of interest capitalized. There was no cash received or paid regarding that loan during the year. Is that right?
Yes.
But
when you look at loans to partner, or is it irrelevant?
I got you.
When you look at loans to partners, or isn't it relevant over here?
The loans to partners. That one is in operating activities normally. Loans to partners are operating activities. Remember, we included them on the operating activities here. But if they are long-term loans, then we can call them investing activities. Loans to, if they are short-term, it's operating. If they are long-term, it's investing activities.
Oh, okay.
Right. But loan from, it's financing activities. Oh. Right. Any questions there? All right. Then remember we said this was the direct method. Everything from here, going downwards, whether it's the direct or indirect method, is the same. The only part that differs is this one. So I want to show you the operating activities using the indirect method. So that portion is the only thing using the indirect method. Right. When we're using the indirect method, we start with the profit for the year. Right. Our profit for the year was can you give me the profit here? The profit, you just say the gross profit plus the rental income plus interest income minus these expenses. So you don't have to talk about the, is it 478, 890? Okay, let me just show it here so that 478, 890 plus rental income 2400 plus investment income 15,300 plus a minus 30,750. This one is minus. Minus 226,804. These are the expenses. Minus 8550 minus 155521 minus 91035. What do we get?
$1930.
Hello?
1930.
Positive.
Positive, yes.
All right. So this was our profit. Then we have to have adjustments. Adjustments we can classify into two. We have non-cash items. They have to be adjusted back, which is depreciation, impairments, we'll have fair value gain on investments held for trading. Fair value loss on investments held for trading. Profits on sale of non-current assets. Loss on sale of non-current assets. Right, so all these things they have to be reversed. If it's an expense, we have to add back. If it's a liability, we have to, if it's a income, we have to subtract all these non-cash items. We are saying these items do not involve cash. They are not cash per se. Even the profit or loss on sale of non-current assets, the profit or loss is an accounting adjustment. What is cash is the proceeds that we receive. Right, so we check if we have got any of those things. So if we check in our statement, we have depreciation here. That's the only item which we have here. So we'll have to add back the depreciation, which is 91035. It has to be added back. Then we also have to have reclassified items. These ones, they involve cash. They are part of cash, but they are reclassified. They are supposed to be shown after the first part. They are supposed to be shown here, these things here. Right. So these things we'll have to reverse them here. Things like tax paid if you are dealing with a CC, interest expense, tax expense, sorry. interest received. Dividends received. These items, they are supposed to be shown somewhere. So in this case, we have the investment income, the interest income of 15,300, it has to be subtracted. The interest expense of 3750. We also have, okay, that's it. I think that's it. So we'll have interest income. We have to subtract, that's 15,300. So this is a reverse process. So incomes will be subtracted and then expense we add, because we're taking them out. We're doing the opposite, what we normally do. Right. Then we get our profit after adjustments. Right. Then we have movements in working capital. Right. Movements in working capital. This refers to increases. Remember, working capital is a current assets minus current liabilities. In current assets and current liabilities. Right. Increases in current assets. It's a minus. Because it means we have invested in our current assets. Decreases in current assets. It's a plus. It means we have invested in current assets. Increases in current liabilities. It's a plus because it means we've been funded by current liabilities. Decreases in current liabilities. It's a minus because it means we've paid them. Right. Here, don't include the following. Prepaid interest, accrued interest, dividends receivable. Bank, tax payable. Current portion of long-term borrowings. Remember, current portion of long-term borrowings is still part of financing. So these things that I've mentioned here, you are not supposed to include them under the analysis of the movements in working capital. All right, so we go here, we check our working capital. Our current assets and current liabilities. We have inventory. It moved from 3480 to 51390. So there was an increase in inventory. There was an increase in inventory. So we'd say here, increase in inventory. That's 51,390 minus 34,8. What do we get?
20, 9,
20,
10.
9, 10.
20,910.
Like this.
Yes.
Right. So that is a negative. Why? Because it means that we invested in current in infant, which is an outflow of funds. Right. Then we go to the next one. Our debtors, they increased from 93,750 to 94,704. Then we'll have our increase in debtors. $94,704 minus 93,750. What do you get?
954.
954 is a minus. Remember, we say that as long as it's an increase in an asset, it's a minus. Right. Then we have our prepaid water and electricity. It decreased by 15,600. It went to 0. Decrease in prepaid water and electricity. 15,600. We'll put it as a plus because we are saying it's an asset that is going down. We have realized the asset. Right. Then we've got accrued rental income. Increase in accrued rental income. Increase in accrued rental income. Remember that rental income, accrued rental income, it's an asset again. Increase in accrued rental income. Minus 10,200. It's an asset which is increasing. Right, I'm just dealing with current assets and current liabilities here. Then we have got, we don't deal with this one. This one is a current liability, but we don't include it, as I said. We don't include liabilities to do with interest. Right, we have got creditors control. There was an increase from 109 to 196. Increase in creditors control. $196,320 minus 109,080. What do you get? It's a plus when a liability goes up. Remember, increase in current liability is a plus. That means we're funded by our creditors. What do you get?
$92760.
It's what?
92760.
I think I made a mistake on this figure, isn't it? It's supposed to be what? 196,320.
Oh.
He said, what do we get?
$87,240.
87240.
Yes.
Right. So these will be the movements in working capital. Right. Then we get our net cash generated from operations. Sorry. Right. So this is supposed to give us the same figure as this one. There's a difference here. What's happening? 180,241. There's something left over because this is what gives us this in the indirect method. Let me see. Or on the non-cash items, was also supposed to include the allowance for credit losses. Remember, it's just an adjustment. It's a non-cash item. So here I'm supposed to include, let me just come here on the non-cash items. Allowance for credit losses. You include the difference, which we have here. It's 550 minus 4,500. What do we get?
1,050.
So it becomes 180,241. If you check here, that's 180 also 241. So what we do here using the direct method. Remember that using the direct method, we got this, but we also had to do these calculations here. That is replaced by this part that we have done here. So if it's in the indirect method, you do it in this way. Then everything else is exactly the same. Whether you're using the direct or indirect, everything else.
Oh yeah.
Everything else from here. Will be the same.
Okay. So on our notes that you're gonna give us, did you separate the direct and the indirect notes?
No, remember that I just said this is the direct. I wrote direct here.
Oh, okay.
Then here I wrote what? Indirect.
Oh,
and
okay.
just know that it's only that part that has got a difference here.
Oh,
This
okay.
part, everything else, I'm not going to repeat. Everything else from the interest here, it's exactly the same. So that means when you are doing the indirect from here now, you now say interest received, interest paid. You are finishing up everything. Everything else exactly like what we did about. Right. So that's our statement of cash flows. So you can try other questions also on statement of cash flows in your study guide. I'll also
Alright,
send you
okay.
maybe some so that you can practice.
Oh, okay. Thanks.
Right. So my friends, we'll continue on Tuesday.